Welcome to the discussion of Module 2 of our subject Risk Management. So, this module will tackle the definition of business risks first before understanding the further concepts that it contains. Also, this module will allow the students to know the different types of risks that every business should plan for. Likewise, this will also introduce students to the different ways on how to identify and manage the causes of business risks. So let's discuss first the learning objectives. First is state the meaning of business risk. Second, identify the importance of managing business risk. And third is to formulate on which has the most severe impact and how likely to occur among the different types of risks. So let's discuss the definition of business risks. So what is a business risk? A business risk is a future possibility that may prevent you from achieving a business goal. So the risks facing a typical business are broad and include things that you can control, such as your strategy, and things beyond your control, such as the global economy. Business risk is the exposure a company or organization has to factor that will lower its profits or lead it to fail. Anything that threatens a company's ability to achieve its financial goals is considered a business risk. There are many factors that can converge to create business risk. Sometimes it is a company's top leadership or management that creates situations where a business may be exposed to a greater degree of risk. However, sometimes the cause of risk is external to a company. Because of this, it is impossible for a company to completely shelter itself from risk. However, there are ways to mitigate the overall risks associated with operating a business. Most companies accomplish this through adopting a risk management strategy. So let's understand the business risks. When a company experiences a high degree of risk, it may impair its ability to provide investors and stakeholders with adequate returns. So, for example, the CEO of a company may make certain decisions that affect its profits, or the CEO may not accurately anticipate certain events in the future, causing the business to incur losses or fail. But business risk is a broad category. It applies to any event or circumstance that has the potential to prevent you from achieving your business goals or objectives. Business risk can be internal, gaya nga nung sinabi ko kanina, internal pwedeng yung strategy, or external like the global economy. So you should not manage or treat it um, in the same way kasi magkakaiba nga ang types of risk. You should understand what type of risk you are facing before you consider how to deal with it. Now, what is the importance of understanding the risk? The risk is often described by an event, a change in circumstances, or a consequence. A common definition of risk suggests that risk is the effect of uncertainty on achieving or surpassing business objectives. This effect may be positive, negative, or a deviation from the expected. For example, may forecast or projections and hindi ganon yung nangyari. So without identifying risks, it is difficult to successfully define your objectives and set out strategies for achieving them. It is best practice to integrate business risk management with your strategy formulation and business planning processes. Understanding and managing risks allows you to control and often prevent the financial, organizational, legal, and other ramifications associated with risks. So, business risks refer to a threat to a company's ability to achieve its financial goals. In business, risk means that a company or an organization's plan may not turn out as originally planned, or that it may not meet its target or achieve its goals. Such risks cannot always be blamed on the owner of the company, as risk can be influenced by various external factors, which may include rising prices of raw materials for production, or growing competition, or changes or additions to existing government regulations. So businesses face all kinds of risks, some of which can cause serious loss of profits or even bankruptcy. But while all large companies have extensive risk management departments, smaller businesses tend not to look at the issue in such a systematic way. So there is a risk to every business decision you make. So instead of relying on gut instinct, it's a good idea to use risk management to guide your business decisions. Understand what risk management is and the types of risks that could affect your business. So let's discuss the different types of risks that every business should plan for. Building a business takes work and risks, but some risks are more dangerous than others. So here are a few risks that every business owner should keep in mind. So running a business takes hard work, which can reap the rewards of customers, revenue, and satisfaction. While success is the ultimate goal, business risk may stop you from achieving the goals you set. When it comes to risk management, there are steps you can take. However, here are the 7 types of business risks you may want to address in your company or your future company or business. So first is the economic risk. Ano ba tong economic risk? So dahil ang economy is constantly changing, na lalo na kapag nag-fluctuate yung market, some positive changes are good for the economy, which lead to booming purchase environments, while negative events can reduce sales. So it is important to watch changes and trends to potentially identify and plan for an economic downturn. To counteract economic risks, save as much money as possible to maintain a steady cash flow. Also, operate with a lean budget and low overhead through all economic cycles as part of your business plan. Next is the compliance risk. The second form of business risk is referred to as compliance risk. Compliance risk primarily arises in industries and sectors that are highly regulated. For example, in the wine industry. So there is a three-tier system of distribution that requires wholesalers in the US to sell wine to a retailer. Sino yung retailer? Sila yung nagbebenta sa mga consumers. This system prohibits wineries from selling their product directly to retail stores in some states. Compliance risk involves companies having to comply with these rules that are set by the government or by a regulatory body. For example, there may be a new minimum wage that must be implemented immediately. So are you complying with all the necessary laws and regulations that apply to your business? So dapat oo, 'di ba? But laws change all the time. And there's always a risk that you'll face additional regulations in the future. And as your business expands, you might find yourself needing to comply with new rules and didn't apply to you before. Kasi syempre nagbabago. Nagbabago nga ang mga rules and laws. For example, let's say you run an organic farm in California and sell your products in grocery stores across the United States. Things are going so well that you decide to expand to Europe and begin selling there. So, syempre, that's great kasi magkakaroon ka ng new market. But you're also incurring significant compliance risk. European countries have their own food safety rules, labeling rules, and a whole lot more. And if you set up a European subsidiary to handle it all, you'll need to comply with local accounting and tax rules. So meeting all those extra regulatory requirements could end up being a significant cost for your business. So even if your business doesn't expand geographically, hindi ka naman pupunta sa ibang lugar, you can still incur new compliance risk just by expanding your product line. Let's say your California farm starts producing wine in addition to food. Selling alcohol opens you up to a whole raft of new, potentially costly regulations. And finally, even if your business remains unchanged, you could get hit with the new rules at any time. Perhaps a new data protection rule requires you to beef up your website's security, for example, or employees' safety regulations means you need to invest in new, safer equipment in your factory, or perhaps you've unwittingly been breaking a rule and have to pay a fine. So, all of these things involve costs and present compliance risk to your business. So, in extreme cases, a compliance risk can also affect your business future, becoming a strategic risk too. So think of tobacco companies facing new advertising restrictions. For example, on the late 1990s, online music sharing services that were sued for copyright infringement and were unable to stay in business. We're breaking these risks into different categories, but they often overlap. However, there are many US states that do not have this type of distribution system. Compliance risk arises when a brand fails to understand the individual requirements of the state that it is operating within. So in this situation, a brand risks becoming not compliant with the state-specific distribution laws. Non-compliance may result in significant fines and penalties. So we need to remain vigilant in tracking compliance by joining an industry organization, regularly reviewing government agency information, and seeking assistance from consultants who specialize in compliance. So another example then here in the Philippines, remember when they required the food industry not to use plastic cups, 'di ba, for the environment. So those are the examples of compliance risk. Next is the security and fraud risks. As more customers use online and mobile channels to share personal data, there are also greater opportunities for hacking. Nauuso ang mga hacking ngayon. Masyadong matalino yung mga nag-hack. News stories about data breaches, identify theft, and payment fraud illustrate how this type of risk is growing for businesses. So not only does this risk impact trust and reputation, but a company is also financially liable for any data breaches or fraud. So to achieve effective enterprise risk management, focus on security solutions, fraud detection tools, and employee and customer education about how to detect any potential issues. Next is the financial risk. So this business risk may involve credit extended to customers or your own company's debt load. Interest rate fluctuations can also be a threat. Most categories of risk have a financial impact in terms of extra costs or lost revenue. But the category of financial risk refers specifically to the money flowing in and out of your business and the possibility of a sudden financial loss. For example, let's say that a large proportion of your revenue comes from a single large client and you extend 60 days credit to the client. So in that case, you have a significant financial risk. If that customer is unable to pay or delays payment for whatever reason, then your business is in big trouble. Having a lot of debt also increases your financial risk, particularly if a lot of it is short-term debt that's due in the near future. And what if the interest rates suddenly go up and instead of paying 8% on the loan, you're now paying 15%. that's a big extra cost for your business. And so, it's counted as a financial risk. Financial risks is increased when you do business internationally. So let's go back to that example of the California farm selling its product in Europe. When it makes sales in France or Germany, its revenue comes in euros and its UK sales come in pounds. The exchange rates are always fluctuating, meaning that the amount of the company receive in dollar will change. The company could make more sales next month, for example, but receive less money in dollars. That's a big financial risk to take into account. So it's a good idea to understand the different types of risk your business may face so you can recognize and plan ahead for them. Financial risk is about the financial health of the company. So can the company afford to offer installment payments to its customers? How many customers can it offer such an installment scheme? Can it handle business operations when two or three of these customers are not able to make their payments on time? So making adjustments to your business plan will help you avoid harming cash flow or creating an unexpected loss. Keep debt to a minimum and create a plan that will start lowering that debt load as soon as possible. If you rely on all your income from one or two clients, your financial risk could be significant your financial risk could be significant if one or both no longer use your services. So start marketing your services to diversify your base so the loss of one won't devastate your bottom line or your profit. Next is the reputation risk. Anytime a company's reputation is ruined either by an event that was the result of a previous business risk or by a different occurrence. It runs the risk of losing customers and its brand loyalty suffering. So the reputation, for example, of HSBC faltered in the aftermath of the fine it was levied to poor anti-money laundering practices. So there has always been the risk that an unhappy customer, product failure, negative press, or lawsuit can adversely impact a company's brand reputation. However, social media has amplified the speed and scope of reputation risk. Just one negative tweet or bad review can decrease your customer following and cause revenue to plummet. There are many different kinds of business, but they all have one thing in common. No matter which industry you're in, your reputation is everything. So if your reputation is damaged, you'll see an immediate loss of revenue as customers become wary of doing business with you. But there are other effects too. Your employees may get demoralized and even decide to leave. You may find it hard to hire good replacements, as potential candidates have heard about your bad reputation and don't want to join your firm. Suppliers may start to offer you less favorable terms. Advertisers, sponsors, or other partners may decide that they no longer want to be associated with you. Reputational risk can take the form of a major lawsuit, an embarrassing product recall, negative publicity about you or your staff, or high-profile criticism of your products or services. And these days, it doesn't even take a major event to cause reputational damage. It could be a slow death by 1,000 negative tweets and online product reviews. So what will we do? To prepare for this risk, leverage reputation management strategies to regularly monitor what others are saying about the company online and offline. Be ready to respond to those comments and help address any concerns immediately. Keep quality top of mind to avoid lawsuits and product failures that can also damage your company's reputation. Next is the operational risks. So the third type of business risk Actually, pang six na 'to, it's the operational risk. The risk arises from within the corporation, especially when the day-to-day operations of a company fail to perform. So, for example, in 2012, the multinational bank HSBC faced a high degree of operational risk and as a result, incurred a large fine from the US Department of Justice when its internal anti-money laundering operations team was unable to adequately stop money laundering in Mexico. So this business risk can happen internally, externally, or involve a combination of factors. Something could unexpectedly happen that causes you to lose business continuity. So far, we've been looking at risks stemming from external events, but your own company is also a source of risk. So operational risk refers to an unexpected failure in your company's day-to-day operations. It could be a technical failure or it could be caused by your people or processes. So in some cases, operational risk has more than one cause. For example, considering the risk that one of your employees writes the wrong amount of a check. Instead na 100,000 pesos, ang isulat niya, ang nalagay is 10,000 from your account. So that's a people failure, but also a process failure. It could have been prevented by having a more secure payment process. For example, having a second member or staff authorize every major payment or using an electronic system that would flag unusual amounts for review. So, yan. So, in some cases, operational risk can also stem from events outside your control, such as a natural disaster or a powerful cut or a problem with your website host. Anything that interrupts your company's core operations comes under the category of operational risk. So while the events themselves can quite seem small compared with the large strategic risk we talked about earlier, operational risks can still have a big impact on your company. Not only is there the cost of fixing the problem, but operational issues can also prevent customer orders from being delivered or make it impossible to contact you, resulting in a loss of revenue and damage to your operation. So operational risk occurs within the business system or processes. So for example, one of its production machines may break down when the target output is still unmet. So what will the company do if its machine operators has an accident during working hours? So that unexpected event could be a natural disaster or fire that damages or destroys your physical business. Or it might involve a server outage caused by technical problems, people, or power cut. Many operational risks are also people related. An employee might make mistakes that cost time and money. But whether it's a people or process failure, these operational risks can adversely impact your business in terms of money, time, and reputation. Address each of these potential operational risks. Um, Address each of these operational risks through training and the business continuity plan. So both tactics provide a way to think about what could go wrong and establish a backup system or proactive measures to ensure operations aren't affected. For example, more businesses are using cloud storage to protect company data and rely on remote team members to maintain operations. Automating more processes also helps to reduce people failures. Another one is the competition or comfort of risks. Okay, the next one is the competition or comfort risk. While a business may be aware that there is always some competition in their industry, it's easy to miss out on what businesses are offering that may appeal to your customer. In this case, the business risk involves a company leader becoming so comfortable with their success and the status quo that they don't look for ways to pivot or make continual improvements. Increasing competition combined with an unwillingness to change may result in a loss of customers. Enterprise risk management means a company must continually reassess their performance, refine their strategy, and maintain strong, interactive relationships with their audience and customers. Additionally, it's important to keep an eye on the competition by regularly researching how they use online and social media channels. Next is the strategic risk. Strategic risk arises when a business does not operate according to its business model or plan. So when a company does not operate according to its business model, its strategy becomes less effective over time and it may struggle to reach its defined goals. For example, Walmart strategically positions itself as a low-cost provider and Target decides to undercut Walmart's prices. This becomes a strategic risk for Walmart. Everyone knows that a successful business needs a comprehensive, well thought out business plan. But it's also a fact of life that things change, and your best laid plans can sometimes come to look very outdated very quickly. This is strategic risk. It's the risk that your company's strategy becomes less effective and your company struggles to reach its goals as a result. It could be due to technical changes, a powerful new competitor entering the market, shifts in customer demand, spikes in the cost of raw materials, or any number of other large-scale changes. Paano gagawin? These categories of risks are not rigid, and some parts of your business may fall into more than one category. The risk attached to data protection, for example, can be considered when reviewing both your operations and your business compliance. Next is the opportunity-based risk. So this type of risk comes from taking one opportunity over others. By deciding to commit your resources to one opportunity, you risk missing a better of missing a better opportunity, getting unexpected results. So opportunity-based risk for business include moving a business to a different location, buying a new property, or selling a new product or service. Next is the uncertainty-based risk. This type of risk is from uncertainty around unknown or unexpected events. It's hard to predict these risks or these events and the damage they can cause. It's also hard to control the damage once they occur. So examples of uncertainty-based risk include damage by fire, flood, or other natural disasters, unexpected financial loss due to an economic downturn or bankruptcy of other businesses that owe you money, loss of important suppliers or customers, and decrease in market share because new competitors or products enter the market. Next is the hazard-based risk. So these types of risk come from dangerous situations in the workplace. Some common examples include physical hazards caused by high noise level, extreme weather, or other environmental factors. Equipment hazards caused by faulty equipment or poor processes when using equipment such as machinery. And chemical hazards caused by improper storage or use of flammable, poisonous, toxic, or carcinogenic chemicals. So how will we identify and manage the causes of business risks? So although you will never be able to completely eliminate business risk, proactively planning for it can help. So kailangan mag-plan. Awareness is key in helping you save money and time while protecting the trust, reputation, and customer base you've worked so hard to achieve. So business risk is influenced by a number of different factors, including consumer preferences, demand and sales volumes, per unit price and input costs, competition, the overall economic climate, and government regulations. So a company with a higher amount of business risk may decide to adopt a capital structure with a lower debt ratio to ensure that it can meet its financial obligations at all times. With a low debt ratio, when revenues drop, the company may not be able to service its debt, or and this may lead to bankruptcy. On the other hand, when revenues increase, a company with low debt ratio experiences larger profits and is able to keep up with obligations. So to calculate risks, analysts use four simple ratios: contribution margin, operation leverage effect, financial leverage effect, and total leverage effect. So for more complex calculations, analysts can incorporate statistical methods. Business risk usually occurs in one of four ways: strategic risk, compliance risk, operational risk, and reputational risks. So business risk cannot be entirely avoided because it is unpredictable. However, there are many strategies that businesses employ to cut back the impact of all types of business risk, including strategic compliance, operational, and reputational risk. The first step that brands typically take is to identify all sources of risk in their business plan. These aren't just external risks, they may also come from within the business itself. So, taking action to cut back the risks as soon as they present themselves is key. Management should come up with a plan in order to deal with any identifiable risks before they become too great. Once the management of a company has come up with a plan to deal with the risk, it's important that they take the extra step of documenting in everything in case the same situation arises again. So after all, business risk isn't static. It tends to repeat itself during the business cycle. Finally, most companies adopt a risk management strategy. This can be done either before the business begins operations or after it experiences a setback. Ideally, a risk management strategy will help the company be better prepared to deal with risks as they present themselves. So the plan should have tested ideas and procedures in places in the event that risk presents itself. So, what causes business risk? So, there are basically three causes of business risk. First is the natural cause. Natural causes of risk include flooding, earthquakes, cyclones, and other natural disasters that can lead to the loss of lives and property. So, for example, a delivery truck is on its way to deliver the order of a customer, but is met with a cyclone along the way, causing an accident. So, in order to counter such causes, businesses need to take out comprehensive insurance coverage. Next is human cause. Human causes of risk refer to negligence at work, strikes, work stoppages, and mismanagement. Third is the economic causes. Economic causes involves things such as a rising of prices of raw materials or labor costs, rising interest rates for borrowing, and competitions. And may others pa tayo. There are other factors which can present certain threats to your business, including environmental risks such as natural disasters, political, economic instability in any foreign markets you export goods to, health and safety risks. So, ito yung na-discuss to sa health and safety risk assessment. Commercial risks, including the failure of key suppliers or customers, and workforce risks. Example is maintaining sufficient staff numbers and cover employee safety and up-to-date skills. So such risks cannot always be blamed on the owner of the company, as risk can be influenced by various external factors which may include rising prices of raw materials for production, growing competition, or changes or additions to existing government regulation. Next is the So how will we identify business risks? So first, as mentioned muna, risks are inherent to every environment and business. So they cannot be avoided and therefore must be addressed head-on to minimize their impact. Kaya nga sabi natin, kailangan i-mitigate. So the first step in risk management is to identify the risks in order to cope up with the risk management strategy. So first is analyze the sources that may trigger problems. It is important to identify and analyze the sources that can cause a problem. Risk triggers can be internal and external. Next is you should act now. Managers shouldn't wait for potential problems to become actual problems before they start doing something. So the moment a problem is deemed to be a threat, it should immediately be dealt with by the company's executives by devising a plan of action in the event that the risk becomes an actual full-blown concern facing the company. Next is involve employees. Identifying risks is not the sole responsibility of the managers and top-ranking officials. Management should involve their employees in identifying the risks that they see in their respective departments and train them to handle such risks at their level. Next is make a list of industry-specific risks. So by looking into the industry where the company operates, managers will be able to identify the possible risks that the business may face. If the same risks happen to other companies in the same industry, there is likely chance that it will happen to your company as well. Therefore, businesses should be ready with a list of solutions or steps to address the risk. Next is create a record of risks. Sometimes the same risks arise over and over. By creating a record of all the risks experienced by the company since it started, management will be able to do a regular review of past events in order to detect patterns that may be better prepare the company for future risks. So how will we manage the business risks? Sabi ko nga, it is inevitable, but there are several ways to minimize their impact, such as avoid the risks. So it may sound ironic to suggest avoiding the risk when we say that it is inevitable. But what is meant here is that companies should avoid specific risks when possible. Managers should think of alternatives in order to not have to face the risk. Next is prevent the risk. So in the example of the delivery truck, yung na cyclone, it would help prevent the risk if companies check on the weather prior to sending out deliveries in order to make sure they reach their destination safely. If there is a deemed risk, then they should act to prevent it from happening. For example, by halting deliveries during severe weather. Next is contain the risk. Sometimes there are risks that cannot be avoided or prevented. Companies can choose to contain said risks while putting up safety nets. For example, since all businesses need to access the internet where hackers abound, they may put stronger firewalls and other protective measures in place to ensure their company's safety. So how you can manage risk in your business? Begin by finding out about risk management practices and how you can use them. You should also talk to others involved in your business, including your employees and customers, to decide on the best way to manage risk in your business. Before you decide what to do, you'll need to work out what risks are and which ones are most urgent. So first, identify, ano yun, work out what risks your business could face. Analyze. Find the levels of the risks and which ones are most urgent. And evaluate. Compare the risk against set criteria to decide what to do. Bakit tayo magmamanage ng risks? So by managing risk, you can reduce the impact of unexpected events on your business. Managing risk can also help you to improve your relationships with customers, suppliers, employees, and the community by understanding and managing their expectations. Improve staff confidence in a safe work environment through workplace health and safety and workers' compensation insurance. And keep your business open during natural or economic disasters by having an emergency management plan, and reduce your compliance insurance costs by having a lower risk of damages. You won't always have enough information or the resources to manage every risk. A good risk management plan will allow you to change your approach if it isn't working or when unexpected risks happens. So this ends our module for the types of risks. And for any questions, you may post it in our group chat or in our teams. And please take note of the activities included in the module. Pwede nyo nang sagutin para kapag magpapasubmit na ako, ready na at hindi kayo matabunan ng activities. So, yun lang. Thank you!